Last week, one of the biggest private credit managers in the world restricted withdrawals from a $1 billion fund. Of course, shares dropped and competitors got dragged down with them. And one of the most respected economists alive publicly asked whether this was the canary in the coal mine to something much, much larger. Now, I've been cautious on private credit for a while. I've also been invested for many years, and it's a kind of an interesting dynamic to be both participating but also very aware of what's going on in that asset class. And the asset class, I can tell you firsthand, is not broken, but it's definitely under stress because of how it's been sold, structured, and managed, especially in the higher interest rate environment and especially with retail investors. So today I want to do three things. First is I'm going to explain what's actually happening and why it matters to investors like us. Second is to show the deeper problem that most of the coverage is completely missing around the story. And third, this is the part I really want you to pay attention to, is to tell you exactly what good private credit looks like in 2026, because the rules are changing, but the opportunity in the space is still very real. You just have to know what you're looking at. So let's start with a quick backstory here because the context matters a lot. Now, after the 2008 financial crisis, banks pulled back from lending. They faced new regulations, new capital requirements, and a lot of political pressure. And that left a gap. So mid-sized businesses still needed loans. Real estate that didn't qualify for Fannie or Freddie type agency loans needed financing. And the banks just weren't showing up the way that they used to. So this is where private credit stepped in. It essentially offered financing for these sort of underserved areas and gave investors something that the banks really couldn't, which is higher yields. We're talking, 8, 10, even 12% annually. So the asset class exploded. And private credit assets under management have grown by about 86% just in the last 5 years. So really, this has kind of taken on to a new heyday of growth. But it's also attracted money that isn't necessarily all that careful. So here's what happened last week. Blue Owl Capital, which is one of the largest and most prominent private credit managers, announced that it was restricting withdrawals from one of its retail-focused funds. Now, shares dropped about 10% in a single day, and it took a bunch of competitors with it, from Apollo to Blackstone to Ares Management. And Blue Owl kind of pushed back as to why there was that reaction, and they wanted to control the frame of the narrative around this. And they said they weren't halting redemptions, they were just changing how they return capital. But instead of the 5% quarterly withdrawal window that investors were promised, they're now distributing 30% of the fund's value directly to shareholders. And they actually say that that's better for investors. Now, pay attention, though, when you read between the lines of what actually happened here. A fund changed the terms that their investors agreed to. Investors can no longer request their money back on their own timeline. And the firm's response was to reframe it as a benefit to them. And that's not unique to Blue Owl, by the way. This is how really the entire industry communicates when things start going wrong. The language gets careful, the framing, stays positive and in the benefit of investors, and retail investors generally, especially those who don't read fund documents for a living, often don't catch it until it's way too late. So when a fund that promised quarterly liquidity restricts how you can get your money back, whatever they call that, that's a liquidity event. Now remember that. And separately, just a few weeks ago, BlackRock's own middle market lending fund disclosed that non-performing loans had jumped nearly 300%. And of course, the net asset value dropped by close to 20% in that fund, to the point that BlackRock has actually waived about a third of its management fees, which is something these kind of firms almost never do unless there's something seriously wrong. So we have two major brand name private credit managers showing significant cracks and big red flags within weeks of one another. That is not a coincidence. So here's what I think is actually going on underneath all of this. And it's not really about Blue Owl or BlackRock specifically. It's about incentives. Now, the way that most private credit funds are structured, managers get paid based on how much money they have deployed and how much capital they raised for their next fund. It's not necessarily whether the loans they made are actually performing, it's how quickly they can get them turned. So the incentive is to move fast, it's to deploy capital as quickly as possible, to close deals, and then to quickly turn around and start raising the next fund, right? And when interest rates were near zero and the economy was humming, that strategy worked gloriously. You could underwrite almost anything and it would perform. Standards got looser, valuations got stretched, and nobody really cared because they were getting paid and it looked fine on paper at the time. And then rates went up, obviously very fast. Companies that borrowed heavily at 2020 valuations suddenly couldn't service their debt at 2023 or 24, 25 interest rates. And loans that were marked near full value started to kind of crack and get marked down, that sort of thing. But here's the part that should concern any investor. The executives at BlackRock, TCP, were publicly saying that their portfolio was healthy, even as their own data showed non-performing loans nearly tripling. And of course, investors are now bringing in suits over that, right? That's it's a big no-no in the financial market. But it's not really a story about one bad fund. It's more a story about what happens when you mix misaligned incentives with a decade of easy money and suddenly make that money more expensive. The era of easy money is over, and we're at the point in the cycle where we're seeing who is swimming naked. Now, there's a second problem here that's probably just as important as the incentive issue, and it's how these products were sold to regular investors. This is really relevant for people like us who invest in the space. Now, private credit was marketed as a way to get institutional quality returns, the kind of yields that used to be reserved for pension funds and endowments and sovereign wealth funds. And it's all about the ability to get your money back quarterly, right? This is like marketed as a safer asset class than going in just having an equity bet somewhere. And that sounds great, but the problem is it was a little bit of a fantasy to begin with. So private credit loans are generally illiquid by nature. There are some exceptions, but the bulk of these things can't just be called back and traded within a month. They're usually not traded on an exchange either, and they don't typically have a daily market price. The whole reason that they pay higher yields is because you're giving up some liquidity in exchange. Now, when you promise quarterly redemptions on an illiquid or a less liquid asset, what you're really doing is betting that new money keeps coming in faster than old money goes out and that the loans will go to term and that kind of thing. And that works fine in a bull market. Everybody wants in. But the moment that the sentiment shifts, the moment that investors get nervous and all want out around the same time, the math starts to really break. So you can't sell private loans quickly without taking a hit on price at that point. So you end up gating withdrawals or force sell assets at a discount or kind of just watch the funds unravel or some combination of all of that, which is what we've sort of seen in the last couple of weeks here. And again, this is not just a Blue Owl problem. This is a structural design problem with the entire private credit space of how it was packaged for retail distribution. Blue Owl just happens to be the one standing when the music stopped. And that's where kind of our eyeballs are drawn in. So anyway, here's what I really believe about all this. I don't think the private credit opportunity is completely dead. Now, despite all of what I just shared, the opportunity to earn real yield, to earn real passive income in private markets is very much alive in 2026. But the game has fundamentally changed. And investors who don't understand what changed are going to be the ones that get hurt. So let me walk you through exactly how we think about this at Ocean Ridge and how I look at deploying capital in the space. Now, I have a number of rules within my framework, but the number one rule that I always come back to is collateral is everything. Now, the BlackRock and Blue Owl situations mainly involved loans to mid-sized businesses. These are software companies, e-commerce aggregators, tech platforms, that kind of thing. And when those companies struggle, there's often nothing that they can take back. The collateral is a brand name or a customer list, or maybe some piece of software that's getting deprecated by AI advancements. So those don't typically hold a lot of value during restructuring events. And when we look at private credit, we're really looking for more of like hard assets, real collateral, stuff that has a deep market value. I mean, specifically, I really like real estate, houses, multifamily properties, even if it's short duration stuff like fix and flips. And the reason is pretty simple because in a worst case scenario, like when a loan goes bad and we have to take back the collateral, we end up owning something tangible that has real value. Real estate typically doesn't go to zero. There's a cost to make it new today, and typically that's a lot higher than what we can buy it for if it exists. Whereas maybe a struggling software company, can go to zero a lot easier. So it comes back to my number one fundamental rule I always sort of preach is downside protection first, always, without exception. That is the first filter. Now, number two, we only like to partner with balance sheet lenders. Let me explain what that means. And this is something that almost all retail investors that I speak with, and even some of the allocators I speak with, completely miss. But a lot of private credit funds originate loans with the intent to then go on and sell them up the chain. Maybe there's someone that's aggregating a bunch of loans above them and they'll make a commission for originating a loan and selling it, right? And they pass that risk on to somebody else. Their goal is inherently transactional and to have volume, not necessarily to have good quality loans. And the problem is that this works great until the resale market freezes up. When it freezes, as it did for so many funds over the last several years, the lender is suddenly stuck holding loans that they never planned to own in the first place. They didn't underwrite for that, and that's when they start to get in trouble. And we only really want to work with lenders who hold the loans that they originate to begin with. Those are called balance sheet lenders. They're literally lending off of their own balance sheet. Their money stays in the loan. Their incentive is for that loan to actually perform over its full life. They have accountability if it doesn't. That is alignment, in my opinion. And everything else, it's just a transaction. So that tends to steer a major heuristic for how we like to invest in the space. Now, number three, I am looking at leverage. And I don't just mean the leverage that the loan gives to its borrowers, but it's actually the fundamental question of how does this fund actually generate its returns? Because some of these funds, they'll actually take money from the bank that they're paying interest on or from a lender. They'll take equity from investors, and then that's their pool that they end up lending on. They've all of a sudden incurred a lot of leverage, and they're creating more leverage, but if it's shaky, they could be in trouble there. So, if a private credit fund is promising something like 12 or 13% yields, you really should want to know exactly how they're getting there. Because in many cases, the answer is going to be borrowed money. Some of the funds actually carry more than 100% of their equity in debt, and they're borrowing it just to lend it right back out. Again, works beautifully when the loans are performing, and the minute the music stops, not only can you lose the loan, but you actually owe money on the debt you used to fund it. And that can really wipe out your position. So we're typically looking at funds using conservative leverage. I like to sort of target, I'd say under 50 or 60% of the total asset being debt. Now the returns may be a little lower. We might be talking about 8, 9, or 10%, but they're real. And you keep them, and your downside protection should be so much stronger at that point because you don't have leverage, right? And then finally, I really like to care about track records through cycles. Now, anyone looks like a genius from 2010 to 2021 investing, but we want to see managers who have been through full cycles. I want to see people that have had loans go bad, that have worked through them, that still protected investor capital on the other side. And that experience is worth, a lot more than a polished pitch deck to me, even more sometimes than somebody that says, I've lost no capital in my entire career, because I do then wonder, have they actually faced enough hardship to go through it, right? So to sum this all up, the headlines this week, they're going to make a lot of investors super nervous about private credit. And honestly, some of that nervousness I think is pretty appropriate. The asset class itself, though, is not completely broken. And the nervousness without clarity can lead to really bad decisions, or decisions that maybe go against what that investor might be after in the first place, which could be passive income. So, when we look at the structures that were sold in this, most recent iteration of private credit, they've been kind of carelessly pulled together for retail investors with promises that couldn't be kept. And those promises are now broken. But there's a difference. And knowing the difference is how you find the opportunities that are sitting right in the middle of the noise. So really think about this. If you want to go deeper in how we evaluate private credit and really have kind of a lens on the specific questions that we would ask before committing any of our own capital, I'll share some more investor notes on this in detail, or feel free to shoot a comment or an email over to us. I'll put the link in the bio below. Make sure to subscribe if this is useful. I'm going to be putting out more and more content in the coming weeks here. But this is a great time to be a student of the game, to be looking at the different things in private credit, and to be refining your edge. So good to see everybody here. Bye.